Hello, and welcome to the American Wealth Strategist webinar, where we're going to be talking today about how you can keep more of your money in retirement, divorce the IRS, and keep more of that hard-earned savings. My name is Alicia Hicks, and I'm your moderator today. The information in today's webinar is hosted by American Wealth Strategist. To give you a little background, American Wealth Strategist is a multifamily office located in Plano, Texas. Our clients consist of business owners, investors, and successful career professionals just like you. And we have a core focus on tax strategy and using estate planning proactively to accelerate wealth plans and greatly expand your net worth. I'd like to introduce you to Mike Miller, who is one of those mornings today, huh? I'd like to introduce you to Mike Miller, who is the Director of Operations here at American Wealth Strategist. Mike has over 40 years of business experience with private equity, venture capital, and business operations. Mike directs the team of tax, legal, wealth management, and insurance specialists, which creates a client experience unmatched in the family office industry today. Mike, we can't wait to hear what you have to share today. Taxes are very much on our minds lately.
Yeah, they are. Thank you, Alicia. I didn't realize my name was such a tongue twister, but, sometimes it is. Well, listen, our focus today for all of you that are joining us is understanding taxes in retirement and finding out how much your silent partner, the IRS, takes in your retirement. Then we're going to walk through how to remove the IRS as your partner in these accounts. And we'll look at the benefits and the results of implementing these types of strategies for your retirement accounts. We will conclude by walking through a few case studies where clients have saved millions of dollars. So I'm going to discuss the tax problems associated with the retirement accounts. This is a time-effective and efficient way to shift taxable retirement accounts into tax-free income and accumulation assets. Now, this is a powerful process for diffusing that tax time bomb called our retirement accounts. Because we value your time and ours, we're going to discuss this in kind of a streamlined process for uncovering the issues specific to you, as well as some of these case studies that we're going to present. And finally, we're going to go through these case studies so that we can show you how we use this solution in the past to actually help clients divorce the IRS and shift their taxable investments to tax-free. So what is the key underlying problems that exist with retirement accounts? Well, the real problem starts with taxes in retirement. These taxes are built in, and that's why the government mandates you must withdraw from your accounts by age 72. Over time, this will trigger a net 40% loss on your accounts as taxable events are triggered with each withdrawal. So who is eagerly waiting for these withdrawals? Take a wild guess. So let's talk about one of the solutions we have here, and this may be our most effective tool in terms of size of retirement accounts and what we can do to divorce the IRS, and also how quickly we can do it. It's called the qualified plan rollout technique. Now, this is a way to move your money from always taxed accounts to never taxed accounts. As an example, I will show you that we were able to diffuse the tax time bomb on a $2 million retirement account in only 4 years and reduce the out-of-pocket taxes that client paid by 90%. And yeah, 90%. So we're going to have a very high overview, non-specific approach on this discussion today because your situation is different. Your situation is very unique, and the specifics of your situation, the retirement account sizes and other investments will determine the specifics of any design for you. We've done hundreds of these over the last 7 years, and every single plan design was unique. But let's go into the benefits here. We typically have results like this. Red is the current Uncle Sam's plan. And green is the solution by firing Uncle Sam and divorcing the IRS. In this screen, you see that the wealth that a person can accumulate in Uncle Sam's plan is about $3.1 million. But when you look at divorcing the IRS and creating an alternative plan, can create as much as 15 million in net worth. So let's go through some case studies so you can see the wide range of who this can help. I'm going to use an example of actual clients. We have an engineer, a dentist, and a business owner. So here we have an engineer. He has $2 million in his retirement accounts, which really is a value of $1.2 million after taxes. So if he sticks with Uncle Sam's plan, he will pay $3.1 million in taxes over his lifetime. And that doesn't include what his children will pay in taxes on the inheritance on what's left over. Now, he also had a $1.4 million in a non-qualified brokerage account. And because of the internal transactions and reallocations that will take place, he will pay approximately $2.3 million in taxes over his lifetime. So $2 million in a retirement plan, $1.4 million in a brokerage account. His total estimated taxes over his lifetime with these two accounts will be $5.4 million. But this was the legacy that he chose. In this example here, you can see that if he has stuck with Uncle Sam's plan, he would have accumulated his net worth of about $3.1 million. But with the changes that he made in the program with turning his taxable accounts into tax-free accounts, we increased his net worth to almost $16 million. So let's meet our dentist client. Now, this guy's a little younger. He's 49 years old. Our dentist had $480,000 in his retirement plan and was deferring $80,000 a year for 4 more years. So the total retirement account in consideration was $800,000. And why was he deferring it? Because he wanted to avoid paying 36% taxes on that $80,000 a year. So that made sense. Now, defer on current income, you use the solution to reduce the out-of-pocket taxes by an additional 95%. Current after-tax value of his retirement account is $512,000, and that's assuming a 36% tax bracket. So total taxes over his lifetime would be $1.4 million. He also had $530,000 in non-qualified brokerage accounts, which he would roughly pay about $850,000 in taxes over his lifetime. So $800,000 in a retirement plan, $530,000 in brokerage accounts. So his total lifetime taxes for those two accounts would be about $2.2 million. Now, you see, with Uncle Sam's plan, with his goals of retiring at age 62, that plan would have left him running out of money at age 80, as you can see from the red line. Now, our plan actually got him through retirement worry-free, actually reducing his market risk and left a legacy of $4.5 million for his children and his church. Now, our next example is our 52-year-old business owner. She had $1.5 million in her retirement account, and she's done well for herself. Current after-tax, lifetime taxes paid, but she would pay $6.9 million in taxes over her lifetime. But we can design a plan that would allow her access to defer funds without paying taxes. And she would need about $1.25 million in one of these particular trust accounts. So actually, she used 2 tax-deferred accounts with our solution. And the result was she paid only $6,700 a year in taxes over the next 5 years. But by getting this qualified vehicle for tax-free income and a Roth IRA for herself, which is tax-free, She saved $6.9 million in taxes on her retirement plan. But she also saved $462,000 in taxes using the trust solution at American Wealth Strategist. So for us, the conversation doesn't start until we know what you want to do, your objectives, your concerns, and what your particular situation is. That starts with a 15 or 30-minute phone conversation. So what do you want to see happen to your retirement accounts? We'd love to help you with that answer and walk through what we can do for you. And for us, that's where the conversation really starts. So book a call with us and give us a call today. I want to thank you for joining us, and we look forward to speaking with you very soon.